Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. Property prices might be cooling slightly, but the boom in the last couple of years has been nothing short of extraordinary. While that's good news for those of us already in the market, anybody hoping to get their foot in the door has been faced with a real affordability crisis. There are around 1 million Australians facing deposit gap issues. The amount they can save still falls short of the 20% of the purchase price that banks often require. Only about a quarter of them are able to rely on the bank of mum and dad. So, what are the alternatives? Rent to buy is one. We've spoken about that here in the past. Government initiatives helping eligible Australians to buy with a smaller deposit is another option, though there's not many people that meet those criteria. A third idea is the Shared Equity Deposit Booster, a product developed in Australia by FrontYa. Remember, this is general information only. You should speak to a professional advisor before making investment decisions. Robbie Baskin is the co-founder of FrontYa. Robbie, welcome to Fear and Greed.
Thanks, Sean. Thanks for having me.
So, tell me in English exactly what Shared Equity Deposit Booster is.
Yeah, great question. So a shared equity deposit booster, specifically with FrontYa, is that we will go 50-50 on the deposit and stamp duty, and in return take 25% of the upside plus the amount that we fronted. So we co-invest in the home with the customer, but they retain full ownership rights. They're exclusively on title. We're just simply there to help them to get into the property market. And essentially, we win if they win. And we've designed the product so that everyone along the spectrum will benefit as a result of having this customer enter the property market.
Okay, so say that again, 25% of, just explain those numbers again.
Yeah, I'll give you an example. So let's say a customer wishes to go buy a property. They might have great serviceability, but they're short of the savings necessary to get into the property market. So what we'll do is we'll double their deposit. So let's say they want to go out and buy $1 million home. They may only have, say, $100,000. We'll double that deposit to $200,000, enabling them to now go out and buy that $1 million home.
Yep.
If they then down the road decide to sell that home, or they can exit through a refinance, let's say the home's now grown to $1.4 million. What that means is when it comes to exiting our product, they need to pay back the original $100 that we fronted, plus 25% in the growth of the property. So in this case, 25% of $400,000 or another $100,000.
Okay. So you're very confident in the local housing market, notwithstanding what's happened recently, that it will keep growing.
So we've designed our product to ensure that we can withstand market cycles. We've taken a view that the property market sort of operates in a short, medium and long-term time frame. So in the short term, interest rates have gone up, and that'll reduce borrowing capacity and increase the likelihood that property market will fall. In the medium term, once the RBA tapers the rate rises, what will happen is wage growth comes into effect. That increases borrowing capacity, and that'll increase the price that people can pay for properties. The RBA also potentially could go a bit too hard and potentially cause a recession and bring down interest rates. But over the long term, it's essentially a structural issue in Australia where demand always exceeds supply, given how Australia is built and the taxation dynamics that we have. And so we've designed our product to maintain that long-term exposure to the property market.
Okay. What's the genesis of it? I mean, things like rent to buy have been going for a long time in other jurisdictions, and now it's growing in popularity in Australia. Obviously, we've always had government assistance schemes. What's the genesis of this one?
Yeah, great question. So I met my co-founder Nia at a barbecue, and we were relating about this particular problem. You know, I had a lot of mates who were in similar situations that they were struggling to come up with the savings necessary to enter the property market. And so I'm a data scientist by background. And so when me and Nia got to brainstorming ways to solve this, I said, well, let's take a data-driven approach. And what we did was get 2 million property transactions over the last 30 years and backtest hundreds of different product structures to find the one that best maximized the chance that every stakeholder in the process would win, whether you're now the customer who has access to more savings and can enter the property market sooner and in a better way than what they could before, whether you're now the mortgage broker who previously had to put that customer on a savings plan, they now can give that customer a mortgage today. The lender who was previously blocked from servicing that customer can now access that customer. And whether you're the investor in FrontYa, you now get access to a diversified portfolio of residential property that's exposed to the long-term growth in the market. And so the product structure is very simple. It's 50-50, 25, 50-50 of the deposit and stamp duty in return for 25% of the upside. But we were incredibly deliberate in that product structure, driven by all the backtesting that we've done to ensure that all the stakeholders along the journey are better off having used us than not.
Stay with me, Robbie. We'll be back in a minute. I'm speaking to Robbie Baskin, co-founder and chief risk officer at FrontYa. Okay, so FrontYa, who are the investors? Where's the money come from? Where's that upfront 50% of deposit stamp duty come from?
Yeah, so we launched in February with a $4.5 million seed raise, and with a few family offices and high-profile investors. And this has given us enough of a runway to stand up operations and to fund our first cohort of customers. Once we've now proven the concept, we'll go back out to the market and essentially raise further funding to deploy into our customers' homes. The long-term funding source for this essentially comes from the capital markets. In the US, there are companies who are similar in this regard, but what they do is they'll offer a homeowner the ability to cash out equity from their home. And they've managed to stand up securitization vehicles behind this. And yeah, in the long term, it's possible to achieve a similar result with FrontYa.
So essentially, the goal, once proof of concept, and hopefully the big institutional money, super funds, those sorts of people think this is an alternate investment strategy for them. So they'll put something in with you. What sort of returns are they looking at? Like, we're in that spectrum of bonds through to equities, to offshore equities, to alternates, etc. Where does this sit in that spectrum?
Yeah, so we've in the back testing that we've done, it shows that the returns that we can generate are quite an attractive risk and return dynamic. And that's in part because of the underwriting that we do and the way that we kind of have structured this product to navigate property cycles and ensure we're exposed to the long term. So it historically has performed better than equities over the last 30 years. We've shown that this product has performed better than equities. It's probably a little bit below private equity. But essentially what happens is when a property does well, we get levered exposure to that. And when a property does poorly, there's downside protection in the product. So it means that overall, you tend to get a really positive performance when you've back tested this historically.
And relatively low risk, certainly in Australia, because housing is a low risk asset.
Yeah, look, historically, it's been a low risk asset, and we believe structurally it'll continue to be a low risk asset, at least in the long term. But in the short term, markets can go up and go down. But over the long term, there's a lot of structural reasons why this continues to be a very safe asset.
Okay, so that's on the investor side. On the customer side, and I appreciate it's early days here, what sort of people have shown interest in taking advantage of FrontYa?
Yeah, so we've actually been blown away at the interest that we've received so far. We haven't done too much marketing. We had a small article when we launched, and very recently have started to turn on marketing through socials. And we've found that a lot of customers resonate with this problem. The types of customers that we're seeing are those who don't have the support of the banker mum and dad, which naturally makes a lot of sense. I think if you have access to the banker mum and dad, that's money on tap, essentially, or money that might come with particular relationship constraints.
Where are you going on that one, Robbie?
Yeah, look, the banker mum and dad can often be a complicating factor when you take that money. In fact, we had a customer who had the option of using the banker mum and dad, also had the option of using us. And after doing the math and just sort of considering the dynamics of it all, decided that we were a far better option.
Okay. So who's the customer you want? So I'm sure once the word gets out that you're another option, you will be certainly inundated with inquiries. But who's the customer that you want?
Yeah, the customer we want is those who have great serviceability because of good wages, but just don't have the savings necessary to unlock that full serviceability. So in order to borrow $1 million, for example, you need to have at least $200,000 in order to pay the deposit and stamp duty, and in that case, a little bit of LMI as well. But unless you have that amount of money, you can't actually maximize your full borrowing capacity. And so for these types of customers, it's an incredible product to unlock that full borrowing capacity, maximize your purchase price, and get into your aspirational dream home today, rather than having to wait and potentially not save fast enough than what the property market can grow.
So I have a nephew who's a lawyer who is looking to buy a house now. He's probably mid to late 20s. He just doesn't have the deposit, but he has a really high wage. I mean, what I consider a high wage anyway. It's that sort of person.
Yeah, that's a great example. What we do is we underwrite our customers to ensure that they're not only in a great position to borrow today, but in the future, they're actually going to have income growth or expense reduction to be able to borrow a greater amount in the future. And the reason why that's important is when it comes to paying us back, the most common pathway is through a refinance. And that means they need to borrow the existing mortgage balance that they have, plus our position in the property, and essentially cash us out of the property. And so what that means is we underwrite on customers who have good serviceability growth. And so people like your nephew are a great example where in the future, it's very likely he'll be earning more money. but it's also really suitable for anyone early in their careers, or has the ability to actually earn more money in the future, or expense reduction. We've had some customers who've got kids in their teens, and in 6 years' time, those kids are going to be moving out of home and are no longer dependents. And that means, when that occurs, their serviceability will grow, and those types of customers can be good too.
You just mentioned buying you out. So in a lot of instances, presumably the idea of going in with the 50-50-25, but people actually buy you out as they become more financially stable. Is that right?
That's it, exactly. We want to help you get into the property, and we want you to exit us as soon as possible.
Yep. Okay. Now, FrontYa uses AI, artificial intelligence, to de-risk products. You mentioned that you're a data scientist. I'm just interested how in a market like mortgages, which is a very traditional market, maybe not in the last couple of years, but still the big four banks are the people who do most of the lending. Does AI and data science have the potential to really split this market open?
What we do with our AI is we use it to ensure that we have good investment risk. So I was describing before about how we underwrite customers to ensure we only sort of invest in customers who will be in a position to pay us back. That's the first check we do for our underwriting. And the second check we do is we get comfort on the property. And what we do is we've taken this 30 years of historical data and have used it to say, what about the property do we know today that will inform how we'll grow over 6 years? And use that to say which properties make investment sense at particular prices. So when a customer comes to us, rather than rejecting properties that don't make investment sense, we take the mantra that every asset is a good investment at the right price. And we go back to the customer and say, this is the price where this property makes investment sense. And if you wish to purchase the property, this is the kind of starting price for our 25%. However, not every customer wants their home to be an investment, and they will decide to, if there's personal circumstances or they wish to buy a larger asset to suit their family, they can overbid on that investment price, and we'll still fund them in those circumstances. But what that means is our AI is essentially guiding customers to what makes investment sense for every property. And the idea is to incentivize them to buy properties that make investment sense, but they can also override that if personal circumstances dictate.
Good luck with it, Robbie. Thank you for talking to Fear and Greed.
Thanks, Sean. It was great being here.
That was Robbie Baskin, co-founder and chief risk officer of FrontYa. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.